Good afternoon, dear colleagues. Do you see me? Do you hear me? Okay, fine. I will demonstrate my screen right now. Okay, so do you see my presentation? Okay, so everything is fine. The presentation is macroprudential stress testing and network and interconnectedness analysis. I'm Alexander, the Financial Stability Department, and before we start, I just want to make two notes. First note is that I will leave some time for questions after each section, but you feel free to stop me anytime and to ask me during the presentation. And another note is that the presentation may use simulated or otherwise modified data in order to prevent the inference of banks. So we can, for example, use ratings and not to infer the biggest player in the rating to be some particular bank. I warn you that the data might be simulated. So, and the structure of the presentation will be the following. I will present two blocks. First, an overview of our macroprudential stress testing, or the MST for short, and we will cover coverage of entities, structure, and liquidity risk as one of key inputs to network effects modeling in particular. And then the next block will be network effects. We will cover algorithms, results, applications, and here, once again, I put a disclaimer in the low part of the slide that models and ratings may use simulated data. So let's roll. The structure. According to the IMF's recommendation, our department, the Financial Stability Department, cooperates with other departments, and including Banking Supervision Support Department. So we have the MST, a supervisory stress test, and also a regulation specifying our interaction. And for instance, we exchange data between each other. We provide banking retail data to them, and they in turn provide us inputs for specific risks. Next, you saw this slide last week, so I will skim quickly. Here are the main blocks of RMST. At the first part, we set the macro shock. And at the second stage, losses related to specific risks are calculated. We have liquidity risk, credit risk, market risk, interest rate risk, and so on. And also the gray block, it's many satellite models like insurance risks, fire sales, and they have special applications. And that's why I didn't put arrows here, but just to know that we have many models. And at the next stage, liquidity risk directly affects banks' liquidity, and other risks affect balance sheet and P&L statements, and that's in turn is reflected in the RWA, risk-weighted assets, and capital adequacy. And in the last row, you see two blocks. It's the feedback effects. It's currently being under development, and it's beyond the scope of this presentation. Maybe it will be presented next time for the next IMF mission. And the second block is here, contagion models, and we will consider it in a detail in the second part of the presentation. Next, our goal is, as the macroprudential stress test, is to account all significant players, all significant instruments, so we don't have a rigid fixed criteria. And we consider various kinds of markets, repo, on exchange, and OTC, various kinds of derivatives, securities, loans, deposits, pretty much everything. And in the below table, just very quickly, it shows what kinds of financial institutions do we consider and on which horizons, which risks. So for less than 1 month, we consider banks and central clearing center and market and liquidity risk. Then 1 month to 1 quarter, we consider interest rate risk, and liquidity risk is not considered because we are limited here by data availability, but we are working on that, and I will tell about this later. And we add, apart from banks, we add insurance companies, EC, pension funds or plans, PF, and brokerage. And 1 year to 2 years, we add insurance risk, credit risk, and also to the institutions, we add development finance institutions. Next, let's move to coverage of entities. You also saw this slide last week, so I will skim quickly. As I said, our goal as macroprudential stress test is to account all significant players, and among them could be not only banks, but also non-banks and pension funds, insurance companies, and others. And in order to account for all of them, in particular, we use network analysis. We create these diagrams and see pretty much the structure of these markets. And we analyze different markets: repo, secured, unsecured, money market, various kinds of derivatives, and so on. For example, here you see that there are non-banks among significant players. For example, the red sphere, the green sphere, they are pretty much big, and that's once again emphasizes that we should account not only banks but all other financial institutions in our analysis. And should we pinpoint a significant player here? So, for example, this red sphere, we would got interested in that. What is it? We will analyze it in a more detail and estimate what impact might it have if it, for example, it could default. Next, this slide depicts unsecured money market. And by the way, I forgot to say about the previous slide that the collateral was not considered here because OTC deals are included. So we have liquidity and credit risk exposure. And in reality, this graph would be much slimmer because we have the opposite collateral included, but still universally discarding this collateral allows us for a relative comparison. So the next slide depicts the unsecured market as of 2 dates. And we also see that there are non-banks among significant players. In particular, we see green-blue spheres as development institutions. And on the one hand, this market seems to be more dispersed. So it is shared among more centers, and it might seem more stable. But on the other hand, it is short-term in nature, and it's likely to be more volatile during crisis. So it's also instructive to analyze this market in order, for example, to define our entities coverage for liquidity risk estimation, for example. So let's roll. And all this analysis, this network graphs and other instruments we use in order to calibrate our thresholds for inclusion of different entities. And this slide generally says what institutions we include. We include the largest banks, 65 banks, or 80% of the market. We include development finance institutions. There are 2 of them. It's a Weber Ref and Doma Ref. And also pension funds. There are 11 pension funds, or 90% of the respective market, 14 insurance companies, or 65% of the respective market, insurance market, and 9 brokers, or 84% of the brokerage market. So in total, we have 46 financial groups. Then, about the liquidity. Given that liquidity is one of the key inputs to network effects modeling, and given that we implemented all the recommendations of the previous IMF mission as far as data availability in our infrastructure are concerned, we implemented all of them. I'm proposing to stop a little bit here on the liquidity risk. So I won't bore you with general things about liquidity risk, but just I want to emphasize that it's by no means an even issue. And I put some references here, quotes, and for example, the Ramsey model of the Bank of England, despite more than 10 years since inception, is still considered the state of the art. And even that model heavily relies on the notorious, I would say, rule of thumb. rule of thumb is used every step of the way: data calibration, interpolation, analysis, and so on. And for example, the IMF publication of 2017, it concedes that liquidity risk remains at early stages of development. So I didn't put references for brevity on the slide, but you can easily check this quotes on the internet. And just 2 examples of challenges of liquidity risk. In theory, even a bank, even with negative equity, could stay afloat as long as it's able to roll over its liabilities. On the other hand, for example, the Lehman Brothers failed in the moment's notice, despite it met all the requirements of Basel at the time. So it's not an even issue. And moreover, the Basel has many disadvantages. Yeah, I will move to that a bit later. So about liquidity risk and how we deal with it. Liquidity risk requires, on the one hand, to be bank specific. So you should account for its organization, balance sheet structure, etc. But on the other hand, you should maintain the consistency among banks in order to ensure comparison and ensure homogeneous regulation among them. So what do we do about that? And one of the main inputs that we use is the Regulatory Form 122. And what's special about this form? This form kind of combines the components of the Basel in it. But more importantly, it also includes behavioral estimations by banks themselves. And just bear with me, I will read quote unquote from the regulatory documents what the bank should include in this regulatory form. Stable funds based on established clients' relationships. So they estimate their relationship with clients and not only with quantitative criteria, but also qualitative ones. Operational deposits outflow rate of 25%, unless, quote unquote, there is a significant risk of concentration on the bank's assessment. Third, estimated value and quality of securities during liquidity crisis, assessment of the activity and liquidity of the market for the relevant asset and the possibility of using the asset as collateral. Fifth, estimation of contingent liabilities on the basis of available facts and experience. 6, estimated outflows from derivatives, subsidiaries liquidity needs, redistribution, and so on. The list goes on and on, So this form kind of combines the best of two worlds. On the one hand, it's a bottom-up form because banks not only estimate some easy assets, liquid assets, but they also estimate their refinancing potential that is not limited to liquid assets. And at the same time, we ensure consistency of all these bottom-up estimates by common standards and centralized reporting. So this is one of our main input data 122 form. But Basel, as I already started to say, Basel has disadvantages. It is primarily based on the 2009 crisis parameters, and that is why it may not only miss recent developments in the market, but also it takes limited account of individual banks' characteristics. So, for example, a large SIB bank or systemically important bank is likely to experience less volatility, for example, as compared to internet bank, permitting easy money transfers. But the Basel doesn't account that. So we have universal coefficients, LCR, and so on. And we have a lot of tools at our disposal in order to calibrate and account for this, further account for this bank-specific characteristics. So due to time limits, I will roll quickly through our models. First of all, the Markov switching regime model. This model was recommended by the previous IMF mission, so we make use of it. It's a very handy tool allowing automatic subdivision of periods. So it divides the time series into different regimes like normal and crisis. And as input, you may use, for example, the Amihud price input measure. That's the relative change in price, no matter up or down, per unit of trading volume. And depending on the results you obtain, for example, the coefficients, you see which bank is more resilient during crisis, which is not resilient during crisis, and you can rank them. Of course, there are issues here. The model is very sensitive to the input data, to the parameters selected, like period and benchmarks, but still you can use it for ranking banks. The second model is about the sensitivity of the bank's credit spread to benchmark spread or G spread. So as is known, spread is market risk of credit risk. And as I will show you, it's also a factor of liquidity risk. It's industry standard to calculate cumulative PD using exponential distribution. And just as a note, to use Poisson distribution to calculate marginal probability distribution. But here we use the first one. So I put the formula in the upper left corner. So cumulative PD, it is from exponential distribution. It's industry standards. It's not our invention. Then what you do, you obtain a bank's credit spread from financial information providers like Bloomberg. It may be CDS spread or any kinds of proxy. And you choose a benchmark spread, during a representative period like crisis, 2009, for example, crisis. And you superimpose these two graphs. So you regress the bank's credit spread upon the locked variable of the benchmark spread. And why lock? Because in order to satisfy the OLS requirements, the relationship must be linear. And unless you superimpose these two graphs, it will be not linear. But here we superimpose, so we shifted using the lock, we shifted the graphs to superimpose on each other. And if you, for example, build a scatter plot, you will see the linear relationship. So what we see here, so we obtain this regression equation specific to each bank. And let's see at an example. The gray columns, it's a kind of our stressed scenario. It's not an actual stress scenario that we'd used at the Bank of Russia, it's just a simulation, just an example. So it's our benchmark BBB spread, benchmark stressed spread, because we have taken it presumably from a representative period of crisis. And calculating using as bank-specific formulae, regression equation, we calculate the bank spread, CDS spread, and from that spread, we using the exponential distribution, we calculate the bank's probability of default. So what you are having here, you have individual calibration of bank's probability of default, bank spread for each month and for each bank. Isn't it nice? And it's all endogenous. So you don't assign probability of default. You don't assign spread. You just have one variable, the input, the stressed spread. And from that, you calculate this stressed probability of default, PD, and stressed spread. And using these estimates, you also can calibrate among banks, because some banks will have more or less flat profile. So they are not responsive to the crisis and they are stable, or other banks will have on the opposite a peaked profile. And depending on the regression coefficients, we will calibrate that. And lastly, we used this approach. So you can rank banks by the volatility of their net outflows. Here you take banks' deposits, and you calculate 4 volatilities: deposits, wholesale, retail, and ruble and foreign currency denominated. So you have 4 volatility indicators, and that characterizes each bank's dynamics during crisis. And then you need to rank that somehow. One of the options is to calculate yet another layer of volatility. So you calculate the volatility of each of the 4 indicators: volatility of ruble deposits, retail, ruble deposits, wholesale, and for the 4. So one layer of volatilities characterizes individual banks, And another level of volatilities characterizes the column. And so I put, you see in red, the volatilities of the column. And in green, you see the volatilities of each particular bank. And you sort this out, you sort this column out, and you divide this sample into 6 groups according to, for example, to normal distribution. So you put 2% of the number of banks in one group, 14% of the number of banks in the other group, etc. And you assign to each group an adjustment coefficient, which is equal the standard deviation of the column multiplied by the number of standard deviation a particular bank is from its mean. And just as a simulation example, it's not an actual MST. We have here these coefficients. I put here a bounds, so the corrective coefficient should not be lower than 70% and should not be higher than 130%. And what this coefficient is? That's the coefficient that I apply to individual outflows. So the banks, the lower the coefficient, the better. So the volatility will be lower. And the higher the coefficient, the worse it is, the more volatile it is. And just some of the leads. The highest volatility was demonstrated by internet banks, as I said earlier, and it's not surprisingly. And the lowest volatility was demonstrated by not the lowest, but low volatility. I will tell about it just a bit later. Low volatility by CIB banks, systemically important banks. And on the other hand, you see here by the last row in red, you see here that the lowest volatility is by ruble retail. It's also unsurprisingly. So retail is less active than, for example, wholesale, especially in national currency. And the most volatile here is wholesale foreign. So, and about this lowest concerning the CIB banks. So I was a bit struck when I found out that CIB banks didn't have the lowest volatility. They had a low, but not the lowest. And there is a peculiar nonlinear relationships between the size of the bank and the activity of its depositors. And I concluded that clients of these banks are relatively risk averse. At the one hand, relatively risk averse. They agree to get a lower return, relatively lower return for a perceived safety of funds. But when the crisis happens, this heightened volatility reflects itself, for example, in transferring money. It could be transferring cash or in a foreign bank for that matter. So this heightened risk aversion of the clients of the CIB banks create this nonlinear relation, and that is why not all CIB banks are in the top rating in terms of least volatile outflows. So here we stop with the tools for calibration, and I move to how we estimated our liquidity risk. You see here that the below table is empty, no data here. It's because the data is sensitive and I had to remove it. But I think that it will not spoil the presentation. I will comment general things about how we do it, and probably I will answer your questions, if any. So a quick walk through the variables at first. So the CB is banks' deposits at the Bank of Russia. High quality liquid assets. Then the potential. This is a bottom-up estimate, estimated refinancing potential apart from HQLA, and that is taken from the Form 122 that I mentioned earlier. So that's potential includes behavioral flows. It includes not actual refinancing that the bank has now. It's estimated refinancing that the bank thinks it will be able to attract. And since this Form 122 is a mandatory form, banks are liable for the accuracy of their estimates. So you cannot just out of blue to put any number here. So it substantiates its claims. So the potential is refinancing potential according to Form 122. And then a residual is a residual liquidity after meeting ruble-denominated outflows. So according to our model, we have two steps. First, we meet ruble deficit and then foreign currency deficit. And please take a look at the first two lines. So the sum and the brackets lower than zero. And this is what needs to be refinanced. So that's your outflows subtracted from your high quality liquid assets at the central bank. So it's your deficit, it's what needs to be refinanced. It's lower than zero. And the second line, you see what couldn't be refinanced. So here is you also see here central bank's deposits minus outflow, but also you put here HQLA in ruble and potential in ruble. So the first, it's what's needs to be refinanced, and the second, what couldn't be refinanced. So it's like a deduction in the case of insurance company. It's like a deduction. And the second row, it's kind of liquidity deficit. And what needs to be refinanced minus liquidity deficit, you receive your refinancing, your estimated refinancing. And that's all for rubles. The second pair of equations is the same and follows the same logic. Apart from that, we add in the first bracket, we add HQLA and potential in foreign currency. And that's because there is very little high quality liquid assets denominated in foreign currency at the central bank. So if we didn't put that, the difference would balloon artificially. So we put it here. And in the last row of the equation, we also put residual at what I said before. It's what remained after meeting the ruble denominated outflows. So the very last line, it's our liquidity deficit is a deduction. And the third line, it's what needs to be refinanced. So I deleted all the data from the table because it's sensitive. But in general, I could say that at the time of the stress test, there was a structural liquidity deficit and most of the outflows was covered by unencumbered collateral. It was covered by liquidity attracted under repurchase transactions with National Clearing Center. That is assets that do not satisfy requirements of the central bank. And liquidity deficit in foreign currency was met with FX swaps on the order of several billion dollars, That's it. So the results were quite good, but it was prior to the pandemic. There was a structural liquidity surplus. I'm sorry if I said liquidity deficit. There was a structural liquidity surplus, and that's why we had so good results. And every model is only as good as its predictive power. And I would say that there was an overlap between the banks that were identified as weak according to our model and the banks that were actually either liquidated or bailed out. And there were 4 banks liquidated. So some of the banks were already liquidated when we were stress testing them. So we knew that they are liquidated, but our results kind of back tested it and we confirmed once again, but other banks were liquidated after that. So the model were very accurate. And just returning to what I said earlier, we met all the recommendations of the IMF as far as our infrastructure and data availability is concerned. So we moved from reduced regression to semi-structural model. We account for bank-specific properties and ensure consistency while through centralized reporting and common standards. And plus, we did not limit ourselves to the Basel coefficients. We use advanced calibration. We account even at that level. So at first, bank accounts, using the form 122, it calculates its estimate behavioral outflows. It's already differentiates banks to some degree. And then we use advanced calibration techniques and we differentiate banks even more. So in the end, we have structural approach. But we push the limits further. why we estimate liquidity risk only on the horizon of 1 month? Because we are limited by our data, by our infrastructure, and we push these limits. Recently, there were adopted changes to the regulatory form 125. It's another form, and our MST unit participated in the proposal of those changes, in the discussion of those changes, and it's now adopted. Form 125. It requires more adjustments and it differs from the weighting system that is used for the Form 122, but still it provides more horizons. It's not only 1 month, and also it provides the breakdown on currencies. So it gives us the potential for further improvement, and it's our plan to further improve our model. And we approached the end of the part 1 of my presentation. And just to sum up, I will say that in the same manner, in a similar manner, other kinds of risks are estimated. And then we analyze the sources of those risks. We split them into solo bases and network effects. We consider types of institutions and use it as practical application that I will cover in the second part of the presentation. So now, if you have any questions, I'm eager to answer.
Thanks a lot. Thanks, Alexander. That was super nice. Very clear, basically. You know, sort of from a tech perspective, really clear. I see what you are doing. And I guess my one question is, you know, for example, about what you showed, I think on slide 11 and 12 and 13, somewhere around this, around those slides, you know. Again, sort of technically, I really see what it is, what you do. It's pretty clear. I'm just wondering, like, how, I mean, you know, my impression here is, my interpretation is that this is sort of different little tools.
Yeah.
Right? Sort of like not really connected in a sense, right? Is my understanding correct? It's sort of one tool after another, each gives you some insight, but not really connected.
Yes, these many tools, they are elaborated not in parallel. So at some point we used that tool, at another point we use this tool, and the usage and appropriateness of either tool depends on the task. For example, if we have a relatively small sample of banks, and all these banks have data, for example, in Bloomberg, and we can obtain their spread, the best application would be the second model, because I can very precisely obtain stress probability of default, stress spread for each month and for each bank. But for example, if you have 60 banks or 80 banks and half of them don't have data in Bloomberg, there are small banks, you just use a regulatory form and calibrate them by the volatility of their deposits. And deposits are available. We have access to this regulatory data, and you're free to play with them.
Okay, but basically, again, all of this seems to be primarily about ranking the banks. No, I think that's also like the terminology that you used at various points.
Ranking the banks,
them in terms of risk.
Ranking the banks and assigning a coefficient based on this rating. For example, at this slide, you see I first ranked them, I estimated their volatility, and I assigned different coefficients to them. Coefficients. So the rank is the basis for kind of adjustment for taking into account bank specific properties. And that's very crucial for liquidity risk, because liquidity risk is all about structure. You can have assets blowing up, so you have a lot of assets, but structurally you can have mismatch and the bank goes bankrupt, like Lehman Brothers.
Okay. And just one more point, please, quickly, before we go to the next part. I think on slide 15, you talked about this sort of back testing aspect, right? You said that you were really sort of able to foresee in real time, like which banks are going to be in trouble, right?
Yeah.
I'm just wondering, or maybe ex post you did that.
Yeah, the issue that we stress tested our banking sector at a past date. That was, for example, half year ago. And some banks already were in default. But our results, but at the time when we tested them, they were not in default. So in reality, they were in default and we knew that. But at the moment we were stress testing them, we were using their data. It's kind of look back bias. And in this sense, it was a back testing because we knew that they are in default, but our back test data, the data that we did at half a year earlier, confirmed that they should go bankrupt. But some of the banks, we predicted that they are going to default.
I see. But what kind of sample period was it then? I mean, what kind of window historically over which you did this back testing? Was it just a pandemic year or was it even before?
No, we didn't do our stress test during the pandemic. It was prior to pandemic, if I'm not mistaken, summer of 2019.
Okay, I see. Okay, perfect, thanks.
Okay, so next we move to our second part, and network effects. And we briefly touched upon network effects at the very beginning of the presentation. I considered them when we examined the coverage of entities. So in the in the introductory slide, the network effects allows us to estimate the configuration of the network, also estimate significant players, composition of outliers, clusters, and so on. But most importantly, as regards to our presentation, it allows us to estimate channels of systemic risk propagation. And also, it will be the last part of my presentation. It allows us to assess the expediency of the regulator providing banks with liquidity or capital support. So I will cover it in more detail later. Here, just also an introduction. The input data, first we have gross deals among banks. At the next stages, we remove intergroup deals and also remove deals with bailed out banks. And the latter is because the bailed out banks, it's already realized risk and it's covered. So we just remove them. And in the lower part of the slide, I show the differences from the Espinosa-Vega. So in general, we use this algorithm because it was proposed by the IMF 3 years ago. But we have some differences. We consider not only banks, while in the version of the model that was presented by the IMF, there were only banks. And also the basic version of this model was on individual basis. And we also consider group support. I will cover it in more detail later. There is no need to reiterate all the specs of this Espinosa-Vega model because it's proposed by the IMF itself. But generally, for who doesn't know, just a brief introduction, that the Espinosa-Vega model assumes a designated party like H designated party to default. And it entails two kinds of risks, funding risk and credit risk. And the losses are subtracted on the one hand from equity, that's the credit risk, and on the other hand from high quality liquid assets, adjusted from discount sale factor and from the for the fraction of short-term liabilities rolled over. And for example, in our case, we assumed 10% for on-exchange repo as a sell discount factor. So 90% were retained and lost 10%. And for other kinds of instruments like OTC, we assumed 100% we lost. So effectively, it was subtraction twice from our equity and high quality liquid asset, which is a more conservative approach. This is a group support. So at first, we have an endogenous shock. So we don't set each bank exogenously to default like it was in the, so I'm sorry, in the MST, I forgot to tell about that. In the MST, our shock is endogenous. So we have a sample of banks that defaulted, reacted badly to our per-specified market shock. And then the shock is propagating. But Espinosa-Vega assumes exogenous shock. So it sets to default each particular bank. And if, for example, you have 500 banks, you have 500 system-wide shortfalls due to default of each particular bank. So here in the Spinoza-Vega, we have this exogenous default. And then if a bank is a part of a group and the support of the group is sufficient, it is saved. If it is not part of the group or the group support is not sufficient, it fails. And the group support is basically the liquidity and capital net of their own outflows pulled together. So it's kind of a fractional reserve. So we, if several banks draw from this pool, we kind of not account from that. But I will cover that a bit later. And here we have also an empty table because the data is sensitive. I was asked to delete it. Just 2 notes. The first note is that you see 1 month column, and the last row, the fraction of network effects in the cumulative losses, and you see 0 here. It's seemingly very small. How is it possible that you have 0% of network effect, 0? That's because we have endogenous shock. So we don't set each bank to default. And here on this horizon, and we have a growing, progressively growing rigidness of our stress scenario. So on the 1 month, nobody fails, we have 0 network effects, but then they grow. And in the last column, you see 2.5%. So I ask you to remember this figure. I will return to this later. So the message is that we have little network effects in our MST. And the second note is that this...
May I? Sorry, just a quick clarification, if I may. You said here on this slide, it's like an endogenous response, right? So does it mean it's really the point where it's integrated with the solvency stress test?
Yes. And later I will show you a sample data when we set the shock exogenous. So here it is what we add to our MST. So we have the macroprudential stress test solar basis, and then you add this network effects via satellite model. But the propagation starts not exogenously when you set each bank individually, but from endogenous sample banks, and they start this propagation effect.
Mm-hmm. And so, Alexander, have you fully integrated it sort of period by period? Or is it only sort of at the end of
it stops at the 4th iteration. We did it in order to reduce calculation time, and we assume that beyond that there won't be a large difference. But it's a classical algorithm that you proposed. So there is parallel spirals, but they stop at the 4th iteration. So the second point I wanted to make about this slide is that these horizons are self-contained. So you have shock specified for each horizon separately, and you have different, independent from each other, this propagation. So this 1 month doesn't impact 1 quarter or the other way around. And since they are independent, they are not additive. So you don't add this network losses among periods. And the last figure, 2.5%, is a proxy of the cumulative losses over the 2 years. And also, I have limited flexibility in showing you the breakdown by types of institution, but on the horizon of 1 quarter, the network effects were due to only 1 interaction among bank, non-CIB bank, and CIB bank. Only 1 interaction. And on the next slide, I will show you the breakdown by kind of financial institution for 1 year and 2 years. So here it is. So there is no data. We'll pretend that they are, but several points that I will make. First point is the source of network effects. It's the first column of the table, and you see that they are exclusively non-CIB banks. Non-systemically important banks are the sources of this network contagion effect. So they default, don't return money, and create this spiral. And on the other hand, the first row, the loss absorption, shows that many kinds of financial institutions are affected by these first sources. They are CIB banks, non-CIB banks, insurance companies, pension plans, brokerage, and more. And also, you don't see this on the slide, but I can tell that on both sides, the network effects are very concentrated. So on the one side, there are one or two banks that account for the absolute majority of losses, like 80% of losses by two banks, for example, bank one or bank two, just for example. And also on the absorption side, there are two kind of consumers, one or two consumers, depending on the horizon, that absorbs most of this network losses. And in this sense, we also analyzing these tables. We are interested who are they, who absorbed and who consume. And one of the consumers of these losses is, if I'm not mistaken, insurance company. And we analyze on the individual basis all these potential significant players, and may use it for our macroprudential policy or practical application somehow. So let's move next. This is a practical application of what I said. So we have network analysis, this is Spinoza-Vega, and here I will cover exogenous shock, how we run these algorithms. So first of all, our analysis that I demonstrated can use in two directions. On the one hand, it's macroprudential policy. We can, for example, time the introduction of Basel requirements, phased-in introduction of countercyclical buffers, and NCFR, and all things like this. On the other hand, we have CIB's markup for systemic significance. And prior to that, there was a flat markup for systemic significance, 10%. And now a possibility is considered to put differentiate markup. And lastly, we use our tools as a crisis response measure. And that's what I already mentioned. That's expediency of helping banks with liquidity or capital. And in particular, as part of the so-called emergency liquidity provision mechanisms, it was put in place in 2017. And a bank experiencing a shortage of liquidity can turn to the central bank as a lender of last resort. And we cooperate also, at the beginning of the presentation, I told you that we cooperate with the Banking Supervision Support Department in conducting our MST. And in this particular task, we also cooperate with other departments, this Service for Ongoing Supervision Department and Financial Resolution Department. So when a bank experiencing this liquidity shortage, or supervisory bodies identify a potentially problematic bank, those departments come to us and ask for a comprehensive analysis of this bank. And we supply them with a wide variety of parameters. So we give them general analysis of assets and liabilities that are dynamic through time, and also using regulatory forms 303, 302, and 316, we create the whole database. You can see the breakdown of the bank's lending, borrowing by sector, by region, and we put the table like here on the slide in the bottom right corner. We can turn it horizontally by banks or vertically by industries or regions, and we normalize it. So we see that, for example, bank lent 40% in one region, and it's very important. The criteria is not the absolute amount. For example, a bank could lend 1 trillion, say, let's say in Moscow, and 1 ruble in Ryazan. But in Moscow, it would be 4% of the whole market, and in Ryazan, it will be 30%. And we are concerned about Ryazan. So these percentages are by the market of a particular region or a particular sector. So we provide that. Plus, we examine borrowing and lending by banks, loans to and deposits of banks, wholesale non-banks, and retail. And plus, we also calculate using automated statistical software like R language. We calculate different centrality indicators like the networks I showed you, betweenness indicators, eigenvalue centrality indicator. There is no solution which one is best. It depends very much on the network structure. So we use all of them. And finally, one of the blocks of our perimeters is perimeters calculated with iterative algorithms using Espinosa-Vega. And just take a look at the table in the lower part on the left. So you have two index of contagion, its capital and liquidity. And in the version of the model presented by the IMF, the Bank of Russia, there was only one index of contagion, capital. Here we consider two. And this is a system-wide shortfall of liquidity and capital respectively due to a default of a particular bank. And here it is exogenous. So we set a bank to default as a starting point and then consider this propagation effect. Then the third column is a number of induced failures. It's analogous indicator like the first two, but the difference is that we consider the number of induced failures system-wide due to a default of a particular bank. And the last three indicators, there were now not in the version of the IMF's model presented. It's a public funds exposure. It's just how much funds the government has lost. The government, federal government, local government, government agencies, extra budgetary agencies at deposits of the banks or loans to banks lost due to a default of a particular bank. And then deposit exposure is just the same as the previous indicator. The difference is that we consider the losses by our insurance agency, deposit insurance agency. In the very last column, securities portfolio exposure, it's an exception. It isn't calculated using iterative algorithm. It's just a fraction of the value of the bank's holdings in the overall volume turnover of the market. So, and this, we are providing a complex of this data, and the next slide shows a sample. Also simulated data. So you don't assume that the biggest banks is like the biggest in reality, modified, simulated. And since we are concerned with systemic significance, the relative perimeter, we are interested not in absolute data like rubles or dollars. We're interested in relative data percents. And if the indicator is in ruble, initially, we divide it by the sum of the column. For example, the very first column, the leftmost upper cell is 26.7%. It means that this particular bank accounts for about 30% of the banking sector assets. But if the indicator is in percents, for example, you see the yellow cell, 6.7%. Here we have different denominators. Here we have the maximum fraction these banks have among regions. For example, this bank loans to 3 regions, 20%, percentages are relative to the local market. So we don't split the bank's portfolio by where it lends. But for example, its lending accounts for 5% of Moscow market, 3% by Ryazan market, 10% of Tver market, different regions or sectors for their matter. And we ranked these numbers and we select the region or sector where the bank has the maximum fraction. So when the maximum fraction accounts for the maximum fraction of the local market. So we have different denominators here. And having different denominators here, we don't have the sum of this column 100%. It will be like 11,000% or any voluntary number. And in order to normalize it, we divide it percent by percent. And that is why you have this maximum fraction, 6.7%. It's, for example, much lower than 2 columns to the right, 31.9, because 31.9, they have 100% base. And the first column, 6.7%, it had a total, let's say 1000%. We normalized, divided each number, and that is why we have this 6.7%. In the raw data, raw percents, it probably 80% or 90%, for example. So this percent are not comparable. What we are interested in is the rank. And you see this, all these indicators, it's a replication of the previous slide. So here I showed you this table, index of contagion, capital, and here they are as well. So having obtained this table, you can either provide it in this format, and interested agencies can focus on their favorite group of indicators. For example, some of our departments are interested in lending, others are interested in borrowings. Or you can weight these indicators in a weighted average, like the last column in the below table. And there is no even solution how to weight, because different users favor different groups of indicators. This is just a voluntary weights, just for illustration, and you receive a kind of a rating, 70%. 8%, and you supply this information to departments that I mentioned, and also they analyze it and supply it to the working group that makes decision either to help the bank or not help the bank, and what would be the consequences if we will deny the assistance. So this is it. This is the end of the presentation, and if you have any more questions, I would be eager to answer.
Thanks a lot, Alexander. Very nice, really. So I guess we would have actually plenty of questions. It's just that like time is gonna get tight. But anyways, let me try with a few more questions, and we may need to follow up. Okay, maybe like having another meeting or in written form, whatever. So let me try the remaining few minutes, like a few questions. One is just on all this network business, all this network analysis. So is my understanding correct that you really got all the bilateral exposure data for all of these different firm types, including
yes, that's correct.
Yeah, like including development institutions and pension funds, insurance companies, all of it, yeah?
Since a lot of people are involved in the stress test, there might be some differences or peculiarities in cleaning the data for each particular sector. But general principle, yes. As I said, at first point, we have a gross data, so the oppositely directed deals are not, at this point, are not netted. The netting is happening at the later stages when we have these iterative cycles. But as a general principle, yeah.
But again, to be super sure, you mean individual institutions, right? You don't mean sectors like the insurance sector as a total. We mean
no. Individual. The largest, as I showed on one of the first slides, we consider the biggest players in each particular sector, and they, as I remember, 90% of brokerage market, 84% of insurance market. So we consider not all in the market, but the biggest players. Or we can, for example, I didn't tell that we can, for example, make a threshold for our deals. So we don't consider deals 1 ruble because it's insignificant. For example, we consider that's an adjustment. I didn't mention that because it's a peculiarity, but general principle is that we have gross deals.